In this video, we're unpacking one of the biggest reasons that your insurance rates might be way higher than they should be. And most people don't even know it exists. It's called your insurance credit score. And no, it's not your FICO score, and no, you can't check it. What's up, everyone? My name is Eric Hunsaker, and if you've ever wondered why you're paying more than your neighbor for the exact same insurance coverage, this might be the reason. Today, we're breaking down what an insurance credit score actually is, how it affects your premiums, and what you can do to improve it, so that you're not overpaying for years without even realizing it. Let's get into it. Ever wonder why your insurance rates are so high? You've never filed a claim, you drive safely, you take care of your home. So why are you paying more than your friend across town for the same insurance coverage? It might come down to something you've never even heard of: your insurance credit score. Most people don't know this score exists. It's not your FICO score. It's not on your credit report. And you can't even check it. But insurance companies use it all the time. And it could be the reason for your car or home insurance bill and the reason that it's way higher than it should be. So let's break down exactly what the score is, why it matters so much, and how you can improve it so you don't overpay. What is an insurance credit score? An insurance credit score is a number that insurance companies use to predict how risky you are to insure. Now, when we say risky, we're talking about whether you're going to skip your bill or disappear with a company's money. This isn't about whether you're trustworthy. It's about statistics. Insurance companies use historical data to predict how likely someone is to file a claim. And over the years, they've found that people with certain credit habits tend to file more claims and more expensive ones. So insurers started looking at your credit report in a different way. Instead of asking, will this person pay us back on time? They started asking, how likely is this person to cost us money later? That's what your insurance credit score is trying to answer. It's like a cousin to your credit score. Related, familiar, but not quite the same. How is it different from a regular credit score? Your credit score is built to help lenders like banks or credit card companies figure out how likely you are to repay borrowed money. It takes into account how much debt you're carrying, whether you make payments on time, how long you've had credit, and other things like credit inquiries or other types of credit that you use. An insurance score uses some of those same factors, but looks at them through a totally different lens. The goal isn't to determine whether you'll pay them back. It's to determine if you're the kind of person who is more or less likely to file a claim. And while you can check your FICO score or credit report anytime, you usually can't see your insurance score. There's no dashboard, no notification when it changes. It's calculated quietly, behind the scenes, every time you request a quote or your policy renews. Why insurance companies use it? From a consumer's point of view, using credit to set insurance prices might feel unfair. But from an insurer's perspective, it's based on numbers. Actuarial studies, which are basically giant math experiments run on insurance data, have shown that credit behavior is one of the strongest predictors of whether someone will file a claim. In other words, someone with poor credit is statistically more likely to cost the insurer more money. And the industry has leaned into this insight hard. So when you apply for insurance, the company looks at your credit history and calculates this insurance score. If it's high, they assume that you're a lower risk and may give you a lower rate. If it's low, they assume you're higher risk, and that usually means a higher premium. Where it's legal and where it's not. Now, before you get too frustrated, know this. Not every state allows insurers to use credit when setting prices. In California, Hawaii, and Massachusetts, car insurers aren't allowed to factor in credit scores. And for home insurance, California, Maryland, and Massachusetts have similar restrictions. That said, the majority of US states do allow insurers to use credit as a rating factor. So chances are your score is playing a role in how much you're paying, even if no one ever told you that. What actually affects your insurance score? Even though companies don't disclose their exact scoring formulas, we know the ingredients. Most insurers and third-party score providers like FICO use 5 major categories from your credit report. Payment history. This is usually the biggest piece of the puzzle. It looks at whether you pay your bills on time. A history of late payments, collections, or missed payments can drag down your score fast. On the flip side, consistently paying on time is one of the best ways to boost your score. Debt levels. This isn't just about how much money you owe in total. It's about how much credit you're using compared to what's available. If you're consistently maxing out your credit cards, that's a red flag. Even if you're making your payments, carrying a high balance makes it look like you're financially stretched. Credit history length. The longer your credit history, the better. A long, stable credit track record is seen as a sign of reliability. If you're newer to credit or you've only recently opened most of your accounts, that could hold your score back a bit. Recent credit applications. Every time you apply for a new loan or credit card, that triggers a hard inquiry on your credit. A few of these over time is fine, but if you've applied for several lines of credit recently, it could suggest financial instability. Credit mix. This looks at the different types of credit that you have. Things like credit cards, student loans, auto loans, and mortgages. A healthy mix shows that you can handle various kinds of debt responsibly, but this factor usually carries the least weight. So how much does a score really matter? A lot more than you think. Let's say you and your neighbor both have identical homes and the same auto coverage, but you've got great credit and they don't. You could end up paying hundreds or even thousands less per year. Recent studies show that people with poor credit pay up to 77% more on home insurance. For car insurance, the difference can be even steeper. In some states, folks with bad credit pay more than double what those with excellent credit pay. We're talking about a gap of $1,000 to $2,000 per year for the same policy. So yeah, it matters. How do you know if your insurance score is hurting you? Since you can't see your actual insurance score, the best you can do is look at your credit report. If your FICO score is above 700, you're probably fine. Scores above 800, even better. But if you're below 600, there's a good chance your insurance rates are taking a hit. You can also ask your insurer directly. They might not tell you your exact score, but they're required to disclose if credit was a factor and what general risk tier you fall into. Can you improve your insurance score? Absolutely. The good news is most of the steps you'd take to boost your regular credit score will help here too. Start with the basics. Pay all your bills on time. Set up reminders or auto pay if you need to. Payment history is huge. Then work on reducing how much of your available credit you're using. If you can pay down some of your debt, especially revolving debt like credit cards, it could make a big difference. Avoid applying for a bunch of new credit lines in a short time. It doesn't mean you can't open new accounts, just try to space them out a bit. And check your credit reports regularly for errors. You can get free copies once a year from each of the 3 major credit bureaus at annualcreditreport.com. If you see anything that looks off, a late payment that wasn't late, or a loan you didn't take out, dispute it right away. Credit mistakes happen more often than people think, and correcting them can give your score a quick boost. How long does it take to see results? This isn't an overnight fix. Improving your insurance score, like your credit score, takes time. But if you stay consistent, you'll likely start to see changes within a few months. And once your credit looks stronger, you can go back to your insurer and ask them to rerun your quote. Some companies will re-rate your policy midterm if you've had a significant improvement in credit or finances. If not, make a note to shop around when your policy is up for renewal. Why this all matters more than ever. With insurance costs rising across the board thanks to inflation, higher claim payouts, and more frequent natural disasters, your insurance score is playing a bigger role than ever in how much you pay. The difference between someone with a great score and a poor score can be thousands of dollars over a few years. That's money that could go to savings, your mortgage, or even just a few stress-free weekends away. And the thing is, you don't have to accept the first quote you get. You can improve your score. You can ask questions. You can shop around. Want to see what rates you actually qualify for? If you're curious what kind of insurance prices you could get based on your situation, check out the home insurance survey or the car insurance survey down in the description below. They're quick, easy, and they help you compare quotes side by side, so you can see if your current rate is fair or if it's time to make a move. So to get started with those, just click the links down below in the description. The homeowner's insurance survey will ask these few questions right here, and if you click on the car insurance survey, it'll ask you a handful of questions just like this. It's totally free, and it's just down in the description below. Insurance credit scores may be hidden, but their impact is real. They affect what you pay, how you're rated, and how much you might save just by improving your credit habits. Now that you know what's behind the curtain, you're in a much better position to take control. Tidy up your credit, ask your insurer the right questions, and don't be afraid to look for better options. Because a lower score doesn't have to mean a higher price. Not forever. Anyways, thanks for watching. If you've ever been surprised by your insurance rate or found a way to save, drop a comment and share your story. It might just help someone else do the same. And if you want to see which insurance option is best for your situation, we'll leave our affiliate links below to surveys that you can take. These are affiliate links, which means we earn a small commission when you use them at no extra cost to you. And your support through these links helps keep our channel going and allows us to continue to create free content just like this. So if you end up using them, we truly appreciate it and thank you very much. Other than that, thank you so much for watching, and we'll see you here in the next video.